Well, hello and welcome to Trading Blows from TraderX. Another busy show this week. Plenty for us to discuss. We've got the ECB decision due up a little bit later on today. Will they spring a surprise like the Reserve Bank of Australia did a little bit earlier in the week? We'll also have a look at the equity market, how stocks may navigate earnings season as that continues after some strong beats from big tech names last week, and also as concerns over the regional banking sector in the US seem to make a resurgence once more. And we'll also get into Ryan Paisey's second favourite subject, which is the monthly US labour market report. Plenty to get into, so let's start the show. So as I said, it's a busy show this week, plenty for us to get into. So without further ado, let's meet our panelists. As always, they'll go head-to-head over 4 rounds. They will score points for a great response and have the threat of points being chalked off if a dispute is raised over their answer. Of course, the better their response, the more points they will score. The panel are back for a second week running. Hopefully this week we won't be interrupted by any fire alarms or any other peculiar goings-on in this building. Joining us then is from down in South Africa, Arno with a fresh new haircut, market analyst. Ryan Paisey, who clearly has somewhere that he needs to be after this recording is done and dusted, the founder of PiQSuite. And last but by no means least, and without his comedy glasses, Linton, the head of the European desk at Newsquawk. With that said and done, let's get on to the first round. So I want to start this week by talking about the ECB. Are we expecting any surprises from our favourite central bankers over in Frankfurt this week? We've obviously had a fair bit of data out this week. We had the bank lending survey on Tuesday morning. We also had the latest inflation data, which showed core prices rolling over, but a re-acceleration in the headline rates. Adam, let's start with you, because I'm sure you'll be squawking the decision live on Thursday lunchtime. What should we be expecting from the ECB at this decision, and also
brilliantly squawking it as well?
Thank you very much. From my friend dressed as a Tesco store manager.
Wow! Wow!
Right off the bat.
I'll give him a point for that. Yeah, okay, yeah, fair enough. Wow.
On a more serious note, I think, when you think about the nuance we've kind of got surrounding the Fed this week, I think this one's a little bit of an easier one for the ECB. I think the top line rate decision will be 25 basis points. And then in terms of the kind of loose-ish guidance that we've got at the moment, they'll suggest that rate decisions will be data dependent going forward. The way I've kind of been previewing it is we've kind of had 2 kind of primary inputs into kind of thinking for this decision. So obviously we've kind of had the financial stability concerns raised by the bank lending survey, as you pointed out, Michael. And, the main message from that was just in tightening credit conditions and a drop-off in loan demand. And for the latter, that was the biggest drop-off since the global financial crisis. So yes, this is things that to be expected, but I think the extent was slightly greater than some people had been looking for. And it's kind of a signal to the doves, this kind of monetary transmission mechanism has been filtering into the real economy. However, though, as you also mentioned, an hour later, we saw the inflation data, the headline, that was at 7%, and the core did tick down, but, 10 basis points in this kind of cycle isn't necessarily, enough to kind of ring your hat on saying it's the peak in core inflation. So there's still a lot of work to be done on that front. And when you kind of marry those two things together, high inflation, but financial stability, I think you get this step down to 25 basis points from 50, which is kind of that happy place that they'll kind of settle on. For the press conference, I think, the guy doesn't really need to do too much on that front. I think, just stick to the script, say they'll be data dependent, inflation's too high, etc., etc. I think as you kind of get closer to terminal, I think she'll get, dug out a little bit more on exactly kind of how unanimous the decisions are. But, Lagarde, we've seen these things before. She doesn't really give anything away. And sometimes I'm pretty sure she just doesn't necessarily tell the whole truth anyway. If people are kind of wanting to get more insight into that, then yes, you can wait for the minutes in about 4 weeks' time. But, my advice is always to keep an eye on the source reporting around 5 p.m. from some of the major news wires, as they're always briefed on what actually went down in the room by various policy makers. That can actually be a slightly more indicative of kind of the lay of the land, albeit you still need to take those with a bit of a pinch of salt, because you get the most extreme doves and the most extreme hawks kind of coming out in favour of their position. I think for the balance sheets, that's not going to be a factor for this meeting. I think that's very much something we'll see in June. But when it does get to June, it's something you're going to want to keep an eye on, because that is, of course, if the Doves are going to be looking to kind of see a slower pace of rate hikes going forward, then the Hawks may use the balance sheet as another channel to kind of finesse monetary policy. So yeah, I think that's pretty much kind of where my head's at for the upcoming meeting.
No, good stuff. So a 25 basis point hike and some data-dependent guidance. Ryan, I'll bring you and give you a chance to retort to the insult for your fashion sense, and also give us your thoughts on what our favourite friends over in Frankfurt might get up to.
I'll be very honest. Adam's been quite kind, just mentioning the shirt, not the casting caps I'm on, but I'm sure there's other rounds for that. We've all seen those videos. Inappropriate, Ryan, inappropriate. So obviously I agree with what Adam said. 25 is expected. Outside chance of 50. I think JP Morgan reiterated this morning that they're looking for 50, if I recall correctly. So I think what you've got to go into this expecting is 25, but not a hawkish 25, but definitely not a we're now done. It's going to be leading on for, again, chance to do far more data dependent. It's going to be obviously bandied around everywhere. If they do a 50, which I don't think they will, but if they did, it will be a dovish 50. Maybe to appease certain factions within the ECB. Again, when we talk about QT or quantitative tightening as well, I think there's going to be some mention of that. We've got some big TLTRO expiring towards the end of June amid rate hikes, so credit demand's going to fall even further, or be dampened further, should we say. I think it's very important to kind of do a TLDR of what Adam mentioned before about the credit demand slowing, but also it's getting tighter. What that basically means is there's less businesses wanting to borrow, but the ones that are looking to borrow are facing in much sterner kind of requirements to borrow, which is kind of counter to what you would normally associate with markets. The less people want, they're going to offer bigger rates to draw that in. So it shows that banks have no interest whatsoever in lending, really, when you combine those two together. Obviously, I'm definitely no expert on that kind of plumbing side of things, but I'm just talking in terms of your working man's opinion on all this.
You're assuming there, Ryan, that you're a working man, which is
but maybe not for the right reason. Sorry. Anyway, demand, also on borrowing and whatnot. I think it's very important to realise that home demand for home mortgages collapsed further in the first quarter. I think 72% of banks surveyed say they're reporting a decline. So it shows you it's not just businesses that are not looking to borrow anymore. It's also homeowners themselves. Or potential homeowners. What does that mean for the general kind of top-down look? It means that you don't start borrowing if you're fearful of what's coming in the future. So that's something that I would say is definitely weighing on the markets right now. And again, it's another reason why I don't think the ECB should be hiking 50. And I think they'd be mad not to. I think they'd be mad to hike 50. One thing I will say in defence of the ECB and central bankers in general is no matter what they do, it will be wrong. People will hate them for whatever they do. So, they're not going to win. So,
that is very true. That is very true, and I think we've probably all been guilty of that. Perhaps me more than
others.
They definitely could have started.
I'm owning up to that one. Awful puns and slagging off central bankers is what my Twitter's all about these days. So whatever gets followers, I guess. It doesn't work, but that's by the by. Arno, let's bring you into the show. I don't want to become a hostage to fortune here, but just so viewers are aware, we're recording this Wednesday afternoon. You're going to watch it Thursday morning. You've got the small matter of Fed decision in the mix as well. So bear that one in mind. But it looks like the Fed are going to pause when it comes to rate hikes. The Bank of Canada are already on pause as well. The RBA were on pause, but are now hiking again. That's a total shambles in and of itself. I'm sure you can get into that for us. But do you think that the ECB, given the data dependence that Adam said and Ryan said as well, and given the fact that core inflation in particular is showing little sign of coming significantly lower, do you reckon we could end up in a situation where the ECB are the last one hiking in the G10 world?
Look, I think it's possible that they could end up. It's not going to be a far stretch for them to get to what the markets are currently pricing in. I mean, we're at 3.6% now, for terminal rates. So I mean, let's assume we get a 25 tomorrow, we've got one more fully priced and then a half one priced after that. So I don't think it's going to be very difficult for them to get to what the markets have been pricing in. It's one more hike after tomorrow's one if they do 25. So I don't think there's scope for them not to get to that at least. But whether we will see them, rushing off to the races and hiking up to 4%, I don't see them getting there right now. And let's just assume that they do get to what the markets are currently pricing in, which is 3.6%. I think the rate differential story is, we've spoken about this already, is in the price. It's been in the price for the last few weeks. And I think something that's gone under the radar a little bit is positioning on the euro that remains very stretched. And that's showing a little bit of complacency. So, something that I like to do as a tip for the traders out there is that when you look at something like positioning data, don't just look at the contract value as so many do. Rather track something. If you're going to track positioning, track it as a percentage of something like open interest, because I think that gives you a much more accurate way to compare apples to apples with. And if you do that over a basket of, let's say, 12 weeks or 52 weeks, you get a very good sense of when positions might be becoming a little bit complacent, a little bit too crowded on the long side. And I think that's exactly where we are for the euro right now. I mean, we're at close to the 90 percentile over the last 52 weeks on the long side. That's the biggest long position. So it's a loved position. It's been loved for the rate differential story, but I think that's in the price right now. And if you consider the recent data, again, it's strange because I think this is where we can see the market being too complacent when it comes to positions, right? The growth story for the Eurozone isn't that strong. Yes, services came in strong, but the markets are ignoring very obvious risks right now from a manufacturing perspective. I mean, just because services is the bigger part of the economy, I get that. That's fine. But if 20% or 30% of the economy is printing deep into contractionary territory, that's not usually something that you celebrate as a victory on the growth. Right?
To say the least.
To say the least. So I think that's something that's a little bit weird. I think that shows complacency, that the markets are willing to only focus on services and they're not noticing, the damage under the hood. The other thing is, like I said, rate differentials, I think, is in the price. It has been in the price for a while. And I think this means markets they haven't noticed that yield differentials between something like the euro and the dollar and the euro and sterling, it's actually moved against the euro over the last 2 weeks. It's not that positive picture anymore. So if you consider growth, if you consider the bank lending, the survey that we had, that was very negative yesterday, right? So I'm bearish the euro. So I'm looking at that with a much more...
Do you know what? I never have guessed.
So I'm looking at that a little bit more bearish, than I probably should. But it's weird because everybody's looking at the lending standards in the US and it's like, oh, this is so bad for growth. But then we look at the same survey for the Eurozone and I'm like, yeah, that's okay. It's not okay. It's going to be a problem for growth. And I think that once they've seen this survey, I think this is something that's going to give the doves more ammunition than it will the hawks. The fact that core isn't accelerating anymore, and again, we might be wrong. We could see inflation accelerate again, but the fact that core hasn't accelerated, I think that's something that gives the doves a little bit more.
Yeah, it fell in April for the first time since January 2022.
Yeah, and that should give. It's another thing that should give the doves that should give the doves just a little bit more firing power going into this meeting. So I'm not saying they're going to pause, but if let's just assume they do 25, which I think is the most likely, and let's say they do another 25, they could be done. They could be wrapping it up by then, and that's exactly what the markets are priced or have priced in now. If you consider that they just hiked 25 and they don't make any mention of pushing terminal above 4% and they don't make any mention of increasing quantitative tightening, I think that leaves the euro vulnerable going into the ECB tomorrow. Because again, the reasons that's driven that very crowded long position, a lot of those good reasons are now out of the way. It's priced, and I think that even if they just deliver as expected, with what the markets have priced in, there's downside vulnerabilities for the euro right now. That's the way that I'm I'm playing into the
I think
ECB.
a lot of people have hung their hats on these comments from Schnabel, where she kind of really reaffirmed that it's not just a case of peak inflation; they need to see it materially coming lower.
Yeah,
and I think it's all Credit Suisse say that by the time you see that, that'll be more of a Q3 story. So I think, you're really going to see their metal tested, particularly from like you're saying, from like a financial stability perspective before then. And as much as the Hawks are kind of talking tough, the bar to kind of surprise, I think, is pretty high at the moment.
Yeah.
I think one thing that I've noticed is obviously, the fact that we're talking about this. So there's so many things at play at the moment. And as Adam pointed out before, normally you wait until like 5 o'clock and then you start getting the sources comments coming out, as you always do. But occasionally, very occasionally, when there's been a lot of disagreement within the council's meeting and stuff, we've had it in the past where we get sources come out during the press conference or in between the statement and the press conference. I wouldn't be surprised if we get something like that this time.
Yeah,
I think there's so many people that want to hear that want to be heard, obviously via the sources corridor, the corridor of uncertainty. I really wouldn't be surprised if we find there's been some very annoyed people within the ECB Governing Council. So I know, if you are trading it over, I wouldn't recommend retail does trade it so actively over the figure and that in between that kind of figure and the statement. But if you are, be very mindful that there could be some tape bombs dropping on the news wires.
Absolutely. And listen to Newsquawk because they will tell you about it as it happens.
And follow PiQSuite.
And follow PiQSuite, of course.
Yeah.
Well, let's follow that discussion with the next round. Right, I want to talk about earnings, and I'm going to throw some numbers at you. And I can't credit my own work with this. These are from FactSet, who actually, if you are an equity trader or have any interest in corporate earnings at all, which, let's be honest, you really should, FactSet publish some really quite good stuff when it comes to earnings. It's all free. It's really easy to access. They put out newsletters every Friday, wrapping up what's happened the week before, looking ahead to the week ahead. Would thoroughly recommend that you get yourself on that website and mailing list. So we are roughly halfway through earnings season when you judge by the number of firms that have reported. I think it's about 55% of the S&P 500 that have now given us results for the first quarter. We've done pretty well. Expectations were pretty low, but the market has beaten, by and large, those relatively low expectations. I think around 79-80% of firms that have already reported have beaten the earnings per share estimate at the very least. And of course, we had some solid results from the big tech names last week. Ryan, I want to come to you. We've seen the rally in equities stall out again once more at this 4,200 mark on the S&P 500. If a better than expected earnings season can't force us through that level, what do we think might?
Well, I'm still bullish equities, no surprise.
There's like two things that Ryan will always be. One is bullish equities and one is bullish the pound.
Well, you've got to have a team, haven't you? So I'm still bullish equities. One thing, speaking of earnings, I don't get the infatuation with many pundits hating on the fact that big tech provides so much of the upside to the earnings numbers and so much of the upside of indices performance. This is not new. This is how world indices work. This is how the S&P works. This is how NASDAQ works. Big tech companies make up a large share of these indices, and they get most of the headlines simply because they are part of every facet of our lives, right? They're intrinsically linked to nearly everyone's daily life. So don't hate on the fact that they're providing, so much sway into an indices, because fact is they employ more people than anyone else. They put more money into the economy than anyone else. More money spent with them than anywhere else. So just stop hating on that. Do me a favor. Just throw that in the debt ceiling pile. If people are doing that, right? Just that really bugs me. It's like bemoaning that Apple are the new world order and then having a go at me because I say that Apple's indicative of the global economy. You pick a side. Anyway, path of least resistance still up. Sector-wise, if you were looking to play anything on the sector side, why bother? Just get long an index. What do I think will happen if, now that earnings are kind of fading away? like I said before, I still think the path of least resistance is up. The fact is, we've seen before where good earnings and good forecast means that, now that's already priced in. There's nothing else left for the markets to kind of reach on for a surprise upside. The fact that we're not falling, you've got to take that as a positive. If you wanted me to pick a sector or something to get behind, it would be, and this is a gun firmly down my throat, I'd be looking to get along the energy sector, purely because on a medium term, long term play, I do think energy stocks have some upside, energy markets have some upside. But
I'll take the other side of that because it got absolutely wasted yesterday when the banking fears.
Right, so I'm getting long at this price. I'm getting long at this point here, right? Not yesterday. So also, as I said, medium long term play. Okay, well, this make a note of the price, and 6 months time, Mill's on you.
No, because that means I actually have to see you.
Wow. I'll be honest, I don't really follow earnings that much. It's not my bag. It's single stock names and stuff like that. It's not my bag at all. So, I'm probably the worst person you could come to first. But
well, we did. You scored a handful of points, so well done. Adam, what are your thoughts on what's going on? Obviously, you're taking the other side of Ryan's energy trade. Any other sectors we should be keeping an eye on?
So from a sector standpoint, I just want to kind of comment on the breadth issue that Ryan raised. And I think the reason why breadth actually is important, from kind of my perspective, is when you kind of get to you've seen the upside that we've had, and we've kind of seen, the moves that we've seen. You've got kind of searching for, okay, what is like the next catalyst for this upside? And so therefore, you kind of need some of the companies which haven't been contributing to start contributing. And I saw a comment from Goldman Sachs suggesting that basically market breadth is now contracted to one standard deviation below average for the first time in 2020. So if you're heading into an economic slowdown, then, it's hard to kind of see where this upside catalyst really comes from. I think from a macro standpoint, a lot of people are holding out hope for the Fed. And another stat, if people want them, is that typically the end of the rate hiking cycle is positive for stocks. And since in the 6 cycles since 1984, the S&P 500 has posted an average 3-month return of 8%, following the peak funds rate in 5 out of 6 episodes. So it shows there is historical basis for this. However, Goldman Sachs have kind of made the point that the multiples which we're currently at are much higher than some of the ones that we've seen before, and position is unfavourable. So I don't think, this kind of given, when the Fed starts pausing or cutting, I don't think it's necessarily given that we kind of get much of a sustained move above this 4,200. That's why I think you've seen a lot of kind of sell sides still favour something towards like the 4,000, 4,100 mark. I agree with Ryan. I don't think there's like a lot of negative catalysts. I think, some of the banking sector stuff, which I think we'll touch on later, it's not become that systemic at this stage. I don't think we're going to see like a 2008, 2007 kind of move. So I personally think we could kind of get maybe a bit of consolidation, this kind of 4,000 to 4,200 level. But in terms of kind of like sectors you look at, if you think there's going to be a growth slowdown, then naturally you'd favour defensives over growth. I think if you believe in the China growth story, then you want to be screening for any stocks which have high China exposure. Potentially in the US, you could look at some of the mining names. As I mentioned, the commodity space, I don't really favour energy. I thought that move yesterday, yes, there's a few other energy-specific factors in play, but they just got absolutely hosed down. I think we talked on a previous episode about OPEC and, their ability to be able to control the oil price going forward. Given this is not necessarily a demand-side crunch, it's a supply-side one, the bullish case for oil, I don't think is necessarily that attractive at the moment. So therefore, I personally would avoid them. I think home builders, if we're in a rising rate environment, and, as you mentioned, some of the monetary transmission needs to work its way through, you probably want to avoid those. And then obviously banks are a bit of a mess as well, so probably avoid those. You may, in fact, want to do what Ryan said and just buy an index, given it's weighting towards tech. In terms of the next event on the calendar for that, you've got Apple on Thursday, so let's see how that goes.
Yeah, absolutely. Apple earnings after the close on Thursday. I think it's 9:30 Thursday night. If anyone is still at their screens and not in, I
will not be squawking that.
I won't be listening, so it's fine. Arno, I don't mean to keep coming to you last in every round. We will rectify that in the second half of the show, I'm sure. What are your thoughts on the equity market at the moment? I mean, we've had, I think on a relative basis, the biggest outperformance compared to expectations on earnings since the last quarter of 2021. Are you thinking that, the fact we're stalling out here is a sign that the bears might try and wrestle control of things a little bit in a little bit more of a decisive manner?
I think it's certainly possible, mate. I mean, we took a bit of a nosedive yesterday, and that got a lot of attention, especially from the top end of that range that we've been testing recently. But I mean, if you just zoom out a little bit, we are basically where we were at the end of March. We just range bound, Earnings have basically given the markets a reason, in my view, just to stall things out a little bit. We basically flat over the last 6 weeks. We haven't really gone anywhere. Even with today's recovery move as well, we're basically right back in the middle of that range. So, like you said, like the guys mentioned as well, I think if earnings with how it looked wasn't the trigger that's going to push us higher, that does tell us a lot. I think what was more interesting about yesterday's reaction for me, though, and me and Ryan spoke about this a few weeks ago, we said that we think that the labor and growth data will be the catalyst that shifts the market's focus from bad data being good news to bad data being actually bad news for equities. And yesterday's JOLTS reaction, certainly played into that. The big question I think that we can debate on is that whether that was mostly due to the banking stocks pushing lower, or whether we saw some reaction from JOLTS. And that would be quite interesting because, again, that means that bad data could now start feeding into being bad news for equities. I think it's probably a little bit of both, but that's something important to keep in mind. Now, when it comes to sectors and how this could potentially play out, I think I'm going to bring up a topic that most of us will probably hate.
And the debt ceiling.
No, not that much. It's something far worse. It's sell in May and go away. Away. Now, before you hate me for this,
can I take hang on, Ryan? Can I take a point off that?
I was genuinely going to think I'm bringing it up, but I was like, no, the abuse isn't worth it. But I'm glad to see that you've gone for it, Arno.
Oh no, I'm sorry, mate.
In my defense, listen, I hate silly market takes as much as the next guy, right?
Obviously not.
Pretty good research done on this matter, and going back to the 1950s, if you take a look at the average return for the S&P,
or even my time,
it's 8% during November to April, and only 2% during May to October. Now, how this fits into this conversation, right? If seasonality is there, we've got the banking issues currently brewing. We've got the markets unable to rally due to earnings season. Now, if you are a little bit afraid of just buying something like an equity index and holding on to it, if you are going to look to rotate into something like a sector allocation, Fidelity has done some really good work in line with the sell in May and go away type of setup, saying that historically
you're going to lose another point in a minute.
I was going to say, come on.
He's about a minute away from telling us to follow Jim Cramer, whatever he says.
Historically speaking, right? If you are afraid, if you are concerned about volatility, if you're concerned about something potentially pushing the markets over the boundary, then the best place that you can be from a seasonality perspective is what Adam already mentioned, and that's your defensives, right? So that means that staying away from things like your cyclicals, like materials and technology, consumer discretionary, industrials, and meaning maybe rotating into something like consumer staples, maybe utilities. Those types of defensive sectors have done really, really well from both a seasonality perspective. And obviously, again, if we look at the Treasury General account being drawn down, the debt ceiling angst, which we are bound to get, even though it's silly, the fact that earnings couldn't push us higher, I think you can do worse things right now. If you absolutely had to trade equities, I think you can do far worse than just making sure that your sector allocation is targeted towards defensive stocks as opposed to just, buying the S&P or buying the NASDAQ. So that's why I brought it up. Now, the good news is something that might be able to say...
Can I interrupt you? I want Mike to check the tapes afterwards, because I'm pretty sure at the start of this you said short defensives. So if he did say that needs to be a retroactive point.
We're going to have a steward's inquiry later. I'll get Kyriakos to do a forensic investigation of the video.
Check the tapes.
So long defensives, going into this season. And the good news is something that might be able to save me a point is that you can find many of those ETFs on the Pepperstone trading.
You've got to get a point for that.
So I've teed this up pretty well. I mean, bringing up a taboo subject, but obviously there's a saving grace there.
Well, we'll let him off in that case. But I must say, I remember on one of the first shows we did, I brought up seasonality on, I think it was a 10 or a 20-year basis, and Ryan tore me apart. You've just brought it up on a 70-year basis.
Yeah,
I'm not sure we're going to be able to forgive him for that.
No,
but,
I'm not. I don't like this Pepperstone, kind of, sales pitch at the end, just trying to butter up to you after the sell in May. It's like you brought my house and offered to make me a cup of tea after.
I'm not going to mug him off too much because I've already got a few things mentioned waiting for the next round.
Right. Well, let's let Arno compose himself and roll the titles for the second half of the show. Right, Arno, we're going to start with you on this round and see if you can get any other annoying market sayings into your answer. Banks, regional banks in the US, as the guys will know, I send round on a Monday or a Tuesday morning the topics we're going to discuss in each week's show, and I put JPM buy First Republic, crisis over ? Well, given the price action we saw in the regional banking sector on Tuesday, perhaps the crisis is far from over. But of course, Jamie Dimon has, for now, ridden to the rescue of First Republic. Arno, simple question, I guess, but the answer is going to be a complicated one, I'm sure. Can we breathe a sigh of relief, or is there another shoe waiting to drop?
Honestly, mate, I don't know. I mean, in hindsight, it's always easier to look at stuff like this, right? I mean, a few weeks ago, I didn't know Silicon Valley Bank even existed, or even First Republic Bank. I didn't know they existed. I'm like, oh, okay, that's interesting, So I think there's good news and bad news about this regional bank issues that we've had. It has global markets on its edge, so we need to pay attention to it. I think the reason why it's a challenging situation right now, especially for retail traders out there, is that we don't know the plumbing, right? It's very difficult for you to know what's going on in the banking sector. You are exposed to whatever the market feeds you when it comes to stuff like this. You're right. You're exposed to whatever the next headline tells you, and that's dangerous for retail to trade, because you might hear something being squawked out very timelessly by Newsquawk, but if you don't know how to use it, it's a challenge for you, right? So, okay, if Treasury comes out and says something about a specific bank, you might not know exactly how that fits into how that will exactly play out into the market. So. I think the first thing for retail traders just to take ease at is that if you're looking at all of this stuff and you're a little bit confused, that's okay, right? You're not gonna. Nobody's expecting you to dive into the plumbing and know exactly what's going to go on. It's very difficult to try and catch these types of things before they happen. And I mean, let's be honest. It's the big players that get on these things very early is either ones that probably had good information to start with, or it's somebody that gets some information and then suddenly you see the markets trading it. So it's very difficult for the retail guy to get exposure to this. And if this is something that's confusing for you, or something that you feel out of your depth with, there's no harm done just sitting on the sidelines and just watching for now. There's no harm done if you see something. If you see something hit the wires that is really impactful for the markets, then by all means jump on it, trade it in the short term. But as a retail trader, be very careful on trying to position yourself from a macro perspective with this banking sector issues, because you might be getting in just as the rest of the market is getting out, and vice versa, and that can really, really, hurt your account. So just say again.
I said it's not great.
Yeah, I mean, just be careful. I think that's the bottom line when it comes to stuff like this from a tradability perspective. Now, in terms of what can you look for right now, I think the simplest place to look to get a sense of what's going on is firstly just look at price action, and secondly look at the relative banking info that you can get your hands on. Right, in terms of price, the big sell-off yesterday in regional banking stocks, I think generally that's not a positive sign. Right, so when you see a specific sector like that tanking 8% on the day, that tells you, listen, maybe pay attention. There's something going on here, something brewing. Now, again, whether there's probably 0.5% of super elite traders out there that got the info ahead of time and they are trading that. If you get in too late, like if you got in, too late yesterday, they carried you out yesterday, right? So you need to be very, very careful with that. But price action is obviously the first place. So have your KRE and your Euronext Bank ETF or a ticker ready. Just watch it. Keep it on the radar. If something big moves, watch it.
I think, judging by that reaction, I think you may have just stolen a point that Ryan was going to make there.
So keep it on your screen. Obviously something that's interesting as well is if you compare. We don't normally look at the dollar as being correlated to something like regional banking stocks. But if you pull up a trading view chart and you put up something like the KRE and the dollar index, you actually have a fairly good correlation between those two. So the move that
KRE is available to trade on Pepperstone.
Ooh, well done.
the only place for trading, I hear.
On this show, anyway.
Everybody can get one. Everybody should get one for that. No, but if you take a look at yesterday's move in the dollar, yes, there was negative data on the JOLTS side, but the dollar kept up fairly well even after the JOLTS data. And then when we started to see banking stocks tank, when the KRE really pushed lower, all of a sudden it dragged the dollar down lower with it. So you could potentially look at maybe some differentials. So if you compare something like the KRE with maybe European banks, that could maybe give you an edge on something like euro dollar. So I'm just trying to bring this back from a retail perspective and how you could really use that. So that's something that you can look at. The other thing that I think will provide a ton of insight for us, and the Bloomberg Fed, they will have it before us. They will have the data before us, but that's the new senior loan officer survey. I think we'll be getting that on Monday, but obviously the Fed will have access to that for their decision making. So we'll need to be, you'll need to keep a very close ear on the ground to hear what Fed Powell has to say tonight, because he will already give us a very good idea of what that data showed us. I think that for tonight, on a side note, I think that's the biggest risk really for if we are going to get a more hawkish sounding Fed for whatever reason, it's going to be because the loan officer details will be less bad than expected. It won't be as bad as expected. That's really the only out that I can see for them to sound slightly more optimistic than what the Fed expects. But apart from us getting some of that information from the Fed, obviously we can get that data on Monday. And the good news is, if you don't know how to access your senior loan officer survey data, don't worry, because the market is going to be all over that information. You're going to have every single investment bank jumping on that, making sure that their charts hits the screen the first, rotates through the crowd. So all of that information.
Has anyone ever looked at this senior loan officer survey?
I'm pretty sure he's making them up.
Data point.
I'm pretty sure he's made them up.
To be 100% honest, I mean, before March the 9th, I don't think 90% of traders actually looked at that data, but it's going to be critically important now, looking at it from a credit perspective. So those are really the only things that I can think of to look at right now to make sense of what's happening. But again, from a retail perspective, know that when it comes to these types of themes, when it comes to these types of narratives, you are probably out of your depth to trade it. So whatever you do, decide
that's like
make sure that you make it count.
Right, before Arno makes up any other economic data releases, Ryan, what are your thoughts on what's going on with the banks at the moment?
Yeah, well, the PiQ sentiment indicator is saying anyway. I think one thing this does kind of highlight this recent US banking crisis is the fact that Michael Brown needs to get on some US guests, because we've not heard of any of these banks that are going under over here.
That's a good point.
So there is that. Exactly like Arno said, First Republic Bank had never heard of them before. Silicon Valley Bank, never heard of them before. PacWest Bancorp, which yesterday were the latest ones to be getting tanked, never heard of them before. One thing I have noticed is there's plenty on social media suggesting that it is social media that's causing these run on the banks and the run on the share prices, should I say, rather than a traditional run on bank. And certainly fanning flames. Then you can argue that if they are that fragile, or if the situation is that fragile, do they deserve to be in business? It's one of those things. It's, if you take that line that they're that fragile in the first place, you have no right to then bitch about JP Morgan buying them all, because you can't have it both ways. So that's one thing. And again, that's another thing that's been annoying me recently. If you, in regards to like a policy response from the Fed and the Treasury, they're in a massive bind, because they don't want to let on, or they can't acknowledge that it's a massive problem, because that's, so far they're saying it's not a big problem, it's all contained, FDIC are handling it. They cannot now turn around and start issuing like the bazooka treatment to this, whether or not they want to or not. The fact is as well, flush outs of weakness in markets is good. Over the long term, over the medium term, flushing out the weak is always a good thing. And obviously this happens more than ever during periods of like tightening monetary policy. If you think that's a bad thing, then you're part of the problem. What would I do in terms of if I was sitting there right now and I needed to trade, or I had a view, even if I think it's some particular names are going to bounce, I wouldn't be touching these particular names, because like Arno said, you're one headline away from doing your account. So what I would do is, again, the KRE on Pepperstone. Gosh, I've already got a point for it, so don't worry about giving me another one. I'll take it if you want to give it to me. But trade, again, I'm a big fan in letting sub-indexes do the work for you. It's hard enough to call the direction of the market correctly. Don't then stick yourself make it harder for yourself even then by refining it to a particular stock. These sub-indexes and these sectors are there. They're there for a reason. If you can trade them, use them. All right, you're not going to get the 100 up, 100 times upside. But if that's the kind of trading you're doing, I'm telling you now, you're not going to be trading for very long. It'll be exciting, but then it'll be very, very disappointing.
Be exciting for a very, very short period of time.
Yeah, exactly. So it's a bit boring perhaps, but sit out if you can. If you really must, trade the regional bank subsectors.
Adam, what are you thinking? Particularly, I know it's a little bit difficult to ask at this point, given that we don't know whether there's any more of this nonsense to come. But what do you think about the potential longer term implications that this might have on the banking sector? Do we see, higher capital requirements, tighter regulation? Is that going to dent earnings and profitability as we move through the next kind of 6 to 12 months?
It's a tough question to answer, because in terms of the fragility of the US banking sector, on Monday, we thought, the coast was almost kind of clear. And then Tuesday, there wasn't really an obvious catalyst for it at the time. And then we just started dumping. I think, one way that I've kind of seen it framed recently is, March was more a case of panic over these banks with hold to maturity securities. But then since then, they've kind of had a bit more time to get the house in order. The Fed's kind of unveiled some kind of backstop mechanisms. I think the problem now is that there's more of kind of why do we actually necessarily need these kind of regional banks? And, we've seen JP Morgan snap up First Republic on Monday, which, yes, that was obviously kind of a market positive. But then again, if you're a regional bank, because you don't have the insurance cap if you're a business on anything over $250,000, and then B, if you're an equity holder in one of these banks and you're just going to get wiped out anyway, what is the point of these banks? So it kind of depends on, how this kind of affects the US banking sector going forward. If we do kind of see like a period of consolidation, then, do banks start getting treated more potentially, I don't know, as like utilities, for example? Are they too good to fail, and therefore the dynamic of the banking system kind of changes as a whole, because if JP Morgan is just going to snap you up anyway, then that could change things. I think for some of the regional banks, if they do kind of survive, then I think it's going to be more difficult anyway, because they have to be more competitive on things like deposits that will kind of shrink their net interest margins. And then I think in terms of like a legislation standpoint, I think I think it will probably get potentially more stringent. But then if you're a Jamie Dimon, what are you going to say to him at the moment? He tells Congress what to do, not the other way around at the moment. I think it's a difficult question to kind of ask and get too much of an outlook for. But I think, the future of the regional banks are in question. But I think the main thing to think about is it's not really falling through too much into kind of the broader banking sector as a whole. I think it's kind of useful for a framework to kind of keep them separated in your mind and see this as a peripheral issue, which, yes, it could have some impact to the real economy. But if there are these banks to kind of step in and kind of mop up the mess, then really how much, damage is actually going to be done from this?
Yeah, I think that's a really good point. I think it is important to separate them. And another point I'm glad you brought up is, do we need these regional banks? I was speaking with, friend of the show and friend of all of ours, Dick Matthews, yesterday, and he was telling me that there's almost 5,000 banks and deposit-taking institutions in the United States. I think the number for the UK is about 200, 250. I mean, even when you adjust that for population, it's ridiculous. Why?
I saw someone frame them as they're like brick and retail mortars at the advent of Amazon.
Yeah, very much so. You can have a point for that. Well said. On that note, let's get on to the last round of the show. So let's bring the show to an end with the US labour market report. It's obviously a monster week of event risk this week. The RBA, the Fed, the ECB, a whole load of PMIs, a load of other data in the mix as well. But the US labour market report wrapping things up on Friday lunchtime. Adam Linton, what should we be watching out for?
Yeah, so, in terms of this report, we just had the ADP, which I know we shouldn't use as a proxy, but we always do, and we always will.
So the point off territory here.
But I raised it on the fact that it was such a blowout. It was 296,000, but they expected 148,000. So I think, it may have potentially given people a little bit of pause for thought after the JOLTS data that we were talking about yesterday. I think, we're at that stage where we're looking to see the labour data roll over because there's such a gulf in between what the Fed have been telling us is going to happen and what has actually kind of happened. The unemployment rate in the US is 3.5% at the moment, and the Fed has it at 4.5% at the end of the year. So, if you take that across the US economy, that's like millions of job losses that we kind of need to see. Millions. And so, I think we are looking for signs that the labour market is going to start rolling over. I don't think we'll necessarily see it now. I think we're seeing pockets of, like the banking sector and the tech sector announcing mass layoffs, but I think we need something more in the context of like a broader economic slowdown to really see it. One stat I saw is that a Fed rate hike takes about 24 months to fully work its way into the labour market. So since we've been going since March last year, I think we still have quite a bit of further room to run. I think the way that I kind of see the jobs data though is I'm purely kind of framing this in, yes, the Fed has a dual mandate, but for the labour market, it's how the labour market impacts the inflationary outlook. So yes, job losses are good, but ultimately this is a mechanism which could potentially help the Fed hit their mandate at an earlier point than they otherwise would have done. So I think, the reaction, as Ryan always says, even if you had the report before, I don't think it's necessarily obvious, how you'd even go about it. I think Arno made a good point earlier about the JOLTS data. It was seen as a negative, but I don't know if it's necessarily going to be clear with the non-farm payrolls if people then start really thinking about the inflationary impact and then whether we can potentially start getting those Fed rate cuts towards the end of the year. As I mentioned quite a few shows already, the big discrepancy is between what the Fed's been saying and what the market's been pricing. If we do see the labour market rolling over, then does the Fed potentially have to meet what the market's saying, particularly given some of the financial stability issues which we've already raised in the podcast?
Yeah, absolutely. The payrolls number's interesting, isn't it? Because you start off in the markets and it's exciting and it's a big highlight event and your adrenaline's going. And then it gets to the point where you just want the number out of the way quickly and the market to die down so you can go to the pub. And then you get to Ryan's stage where you just go to the pub before the data's released. Is that what you're going to be doing on Friday afternoon, Ryan?
Mate, I'm going to the pub before the Fed decision later.
That's why you're in the show.
I'm in the pub. I agree with everything that what Adam says, apart from the fact that I believe Adam's playing a little bit too much 4D chess there for everyone. Certainly playing too much 4D chess for me. Again, as I say all the time, and as Adam rightly pointed out, I could give you the non-farm payroll breakdown, the revisions. I can give it all to you right now, and you're going to be odds against to make money tomorrow. That's just the way these things are right now. Is the job market really worsening? I'm not too sure. And that was before ADP. I don't, I know the unreliable boyfriend of NFP. One thing that I've noticed and I thought was quite interesting, I was reading up on this morning, is there's still far more job openings in the official employment rates by a factor of 1.64. To give you a guide, pre-pandemic, that ratio was 1.25. So that's the number of job openings versus those needing a job, basically. So what
we're saying there, Ryan, just to get that clear, is even if every single man and his dog and woman and whatever else who is unemployed right now took a job, there would still be vacancies.
Yes. Yeah, exactly. So pre-pandemic it's about 1.25 ratio. Right after the pandemic, when there's people on furlough, but loads of people looking for loads of job openings trying to get people back to work, that peaked up at 2. So there was 2 openings for every 1 person looking for a job. Which is why it gave it was a buyer's market, right? Or seller, however you want to phrase it. So that's why wages went through the roof. So the fact that it's coming down and the job market is softening from where? We're still softening from historically great employment kind of landscape. So that's something that I think we need to factor in. Again, it comes back to mean reversion for the win, right? We're still coming back off a pre-pandemic post-pandemic kind of, oi polloi. I think the NFP is anticipated to come at 175,000, is it? Is it 175,000?
Yeah, I think it was 180 when I looked yesterday. It may have come lower a little.
So, but it could come in at 250, it could come in at 50. These are all, this is all part of the makeup of it. If you're going to look at one factor of non-farm payrolls, look at the revisions of the previous, because at least then they've had a chance to look at the data, especially if non-farm payrolls is remotely in line. Look straight to the numbers on the revision, because that normally gives a bit of a secondary move on the market. Again, if we're looking at trading the non-farm payroll, which I really don't recommend you do, but distinguish between fast money and real money. Fast money, you'll be trading the headline. You'll get a jolt one way or the other. 9 times out of 10, give it 10 minutes, and then for the rest of the session, you'll see the real money coming in. And by real money, we mean funds and banks and whatnot with real positions to put on. These aren't hedges, these aren't punts. This is real positioning. So I'm a big fan of waiting for real money to show their hand. As one thing as well, you're going to hear a lot about over the next coming weeks, in my opinion, and I have not a clue what all this means. But it's the whole, it's called the beaverage ratio, which might even be the ratio I've just been talking about. But I'll be honest, it's in one ear out the other for me.
Not a lot in the middle, so.
Well, exactly. So I don't think, the Fed certainly hasn't got to worry about anything at the moment. It's the economy isn't exactly failing, and the jobs market isn't exactly collapsing. So, don't believe the hype. Fade the hyperbole.
Absolutely. Arno, let's wrap up the show with you, my good friend. Payrolls, is it good news is good news? Good news is bad news? Bad news is good news? No news is what news? How are we playing it?
Mate, I don't have a clue, to be honest. The data has been so tricky to trade. And like the guys have said, NFP, the base case scenario for trading something like NFP is you need to have each and every single one of those metrics coming in either very, very hot or very, very bad. You want a aggregate beat or an aggregate miss. If you don't get that, then you're gonna get yourself into trouble. You want those opportunities, especially if you're trading it from a CFD perspective. You want those opportunities where you don't have to think about what will the markets do? Are they going to buy here? Are they going to sell? You don't have time for that. You want to see, my screen is my calendar is green across the board, or it's red across the board. I'm going to sell or I'm going to buy the dollar. It should really be as simple as that. And when you don't get that type of clear edge, then it's probably not worth trading it. It's probably just worth looking at it. And like Ryan said, if you really want to take a position, maybe wait a bit, see how the market's traded. Wait for the smart money or real money to come in and trade in that direction if you wanted to. But normally even that can be risky, So in terms of tradability, look for those really, really, really clear edges. If you don't get that, it's probably not going to be worth it. Now, just to quickly add on the labor market, we spoke about this a little bit earlier in the week as well, and I think there's a few very interesting relationships right now between the unemployment rate and many leading and coincident indicators. In the aggregate of that information, I do think that all of that information is pointing to a higher probability that we're going to get a jolt higher in the unemployment rate. I mean, you spoke about interest rates and how that could potentially impact something like the unemployment. And Adam mentioned something like 24 months. Now, if you look back to most of the past cycles, your average is about 12 months. So since you get, in all of the hiking cycles that's been aggressive, and I mean, this has been the most aggressive one, in the aggressive ones, you have about a 12-month lag between when the Fed actually starts ramping up rates and when the unemployment rate starts bottoming out and pushing higher. So we pretty much in that threshold now. Other things that really caught my attention is small business hiring plans. I mean, they fell considerably on a rate of change basis. And the lead lag for that is a little bit more mixed. I mean, you're talking about 12 months, there's 10 months, 5 months, and currently we're already at 15 months. So, I think we are getting closer to a stage where we're going to start seeing those things rolling over. I mean, other indicators to watch. And the reason why you do it in the aggregate is that you're not just focusing on hikes, you're not just focusing on small business hiring plans. But if you take a look at retail sales year over year, durable goods, lending standards, the small business loan availability, business activity data, consumer sentiment, you name it. If you take a look at all of those charts, if you track it on a cycle basis, all of them are pointing in the same direction for the unemployment rate. Now, in terms of timing, I suspect that we are not far away from the unemployment rate bottoming out. That doesn't mean that we're going to go from 3.5% up to 6% in a week's time or a month's time, right? It's going to take some time. But I think when the trend starts to change, when the markets are getting more confident that, hey, the trend in the unemployment rate is starting to move in the opposite direction, I think that is when starting to trade things like labor data will get a lot more interesting and exciting for us, because then the market is going to jump on any type of print that we get. In terms of what it means for the medium-term picture, don't get involved in nonsense like that. What I mean by that is, will the Fed cut rates later this year? If the labor market turns out to be super bad, probably. Will they keep rates unchanged for the rest of the year? If the labor market sticks at it right now where it is, then probably not. So we don't have to position ourselves for the next 6 months from now. Does the aggregate of information paint a higher probability that the unemployment rate is going to spike? I do think so. If you're true to the data, it does look like that's the case. But timing that, it's like, do I think that's going to happen Friday? Who knows? We need to wait and see. And the problem is, you might see the unemployment rate lower on Friday, and next month, guess what? It might push up with the revisions, because let's be honest, they need to. They sometimes they do make a mess of collecting the data. So
that is very true. It is always a guessing game.
Be patient. If you get a super clear edge as a retail trader, take those positions. But unless for that, don't bother with the medium-term picture. If it's a messy print, then just sit out. But I do think it's worth paying attention to what the aggregate of data is showing us, because I think that's what will guide the Fed for the rest of the year.
Just quickly a quick one to add on to what my good friend Arno has said, and I do believe he was he should have got far more than the points that he's got for that last bit. But if you really want to get involved in the post craziness of the figure, make sure you're watching 2-year yields. If you have up 2-year yields, what you'll find is figure comes out, markets are moved, equities yields are go. Sometimes, not all the time, but sometimes a very good tell for if the market has gone the wrong way is the yields will start moving back a lot quicker than equities. There's that old adage about bonds don't lie kind of thing. It's kind of there's a little bit of truth to it. Bond market participants tend to be a lot more smarter than, shall we say, like retail punters in equities.
That's why Ryan doesn't trade bonds.
This is why I don't trade bonds, because I can barely spell bombs. But yes, so if and I'm not saying it works all the time, and usual disclaimers that apply. However, if we do get an instant knee-jerk move, more often than not, if it's wrong, the yields will tell you before the equities tell you. So what I normally do, if you did want to be sucked into trading, if the yields reverse quite, substantially, and there's some, some decent power behind, some decent price action behind it, that might be a time to fade the equities. And the same if they then but if the yields go again the same direction, it might be, that's your opportunity to get in and join the equities in that same direction. I
think that's a really great point. And sorry, Arno, we could go on all day. But in the interest of time, we're going to have to bring the show to an end. So let's have a look at the final scores. So Ryan somehow has managed to pull out a win at the end there. I think it was Arno's time in the penalty box earlier on that has consigned him to second place.
Yeah,
he has. He froze a long time ago.
Yeah.
It's just his boyish good looks that we get to stare at now. But Ryan, well done. Congratulations. You've won, I think that's 2 weeks running now.
Well, I didn't want to say anything, but yeah.
That's it. He doesn't want to say anything.
At least it's honest.
On that note, let's bring the show to an end. Thank you to the gents for joining me. Arno Venter down in South Africa, Ryan Paisey from PiQSuite, and assuming he's still there somewhere, Adam Linton.
I'm somewhere in the internet, just looking pensive.
We can hear him. We just
I'm
can't
glad I
see
wasn't
him.
picking my nose with it frozen like that.
That's all you were thinking.
And Adam Linton, head of the European desk at Newsquawk. We got through the show without any fire alarms. Thank you all for watching. If you've enjoyed the show, drop a like on the video, leave a comment as well. We will all see you next week. And also thank you again to our producer, Kyriakos, as well. Thanks again and goodbye.
Kyriakos.